Savita, what a treat for us. Good to see you again.
Likewise. Thanks for having me.
So you say buy high free cash tech. Maybe you can explain it.
Yeah, let's talk about it. So, I mean, I think this is where the quant work can actually help. So what we found for tech companies is that valuation is actually not necessarily a great buy or sell signal. But what you don't want to do is buy companies that are in the process of derating. And these are what we would call kind of the value traps or the growth purgatory companies that, we're trading at very, very lofty multiples, but are now starting to see some risks. And that's exactly where the overall tech sector is, especially some of the higher growth names. So what do you want to look for within tech to know that it's time to buy? Well, what we found is that the cheapest companies tend to outperform. So once they're finished with their derating cycle, but they're still producing lots of healthy free cash flow, those are the companies that generally outperform to the tune of, this is a great strategy within tech. Cheap tech can actually outperform the market, but you really need to look for bottomed out, really cheap tech. So our view is screen the tech sector for free cash flow yield. Look for the companies that are, still generating a strong and visible stream of free cash flow, but aren't necessarily, still in that downward spiral. And that would leave us with some of the more boring names in the sector.
So, for example,
I mean, this is not your internet tech. It's not your, sort of exciting long duration buy the dream growth tech. It's more like your yieldy cash return tech companies. And it's, we find these names in semis and software, in IT services, but they're definitely not the sort of darling tech stocks that we've, sort of seen in this meteoric landslide. I think what's interesting is that when you look at the long duration tech companies, and I call it long duration because really what you're doing is you're paying today to get all your money way out in the future. And these companies, as you would expect, using bond math, are much more hurt by a move in interest rates or a move in the discount rate. Look at this year. We've seen, something like a 50 basis point increase in nominal rates. We've seen the equity risk premium increase by about 25 basis points. So the companies that are getting hurt are the ones that are more impacted by that rising discount rate. And I know you've talked about this on your program before, but I think the risk is we're not at a point where the market is adequately pricing in the moves that the Fed is likely to make. The market's not adequately pricing in the moves and, in inflation in the 10-year. So we think that there might be more to go for some of these longer duration tech companies.
So, Savita, Julia here, I thought your comparison to what happened to tech back in 2000 was really interesting. And I'm wondering how you're looking at that comparison to what's happening right now and how that's shaping your outlook on when all of the tech sector becomes an opportunity to buy.
Yeah, it's a great question. I mean, think about it. From March 2000 to September 2002, we saw PE multiples for the tech sector compressed by 60%. We've only seen 12% from peak to trough multiples today. So there's probably more to go for the overall tech sector. That said, tech companies today in the S&P are very different from what we saw in 2000. These are more, these are real companies generating healthy earnings. They're not the non-earners, the really speculative tech companies that we saw back in 2000. Here's the key, though. I think that you can't just ignore technology because even back in 2000 and 99, 2000, if you looked at the IPOs that took place in 99, 1 out of 4 of the IPOs of 1999 are now these blue chip mega cap tech companies. So you don't want to ignore tech summarily. I mean, there's definitely opportunities within the sector. And I think that's where, looking at free cash flow, looking at earnings visibility, looking at the quality of the business model are going to be really important. But 1 out of 4, not great odds. So I think it's still important to be selective here.